The S&P 500 has taken quite a dip in the past 30 days, and with that, we're starting to see quite a few different dividend stocks trading right at their 52-week low. So in this video, we're going to be looking at 3 different dividend stocks that I believe are currently undervalued and are trading at a 52-week low. The first dividend stock we're looking at that's at a 52-week low is a very popular one for a multitude of reasons, and that is Altria Group, stock ticker MO, and it's currently trading at $41.70. We can see over the past year down around 2%, and year to date currently down around 8.4%, and again, it's pretty clear to see right at its 52-week low. Now, the biggest reason people love this stock is because of the big dividend payments it's been paying out for so long. Look at that starting dividend yield sitting at 9.41%, and they did recently just announce a dividend hike, but also they have a phenomenal dividend history. They've been able to sustain the big dividend payments for 53 consecutive years, and they've grown those dividend payments for 53 consecutive years. So if we look at this dividend history, you can see 10 years ago they were paying out around 44 cents per share every single quarter, and jump forward to now, it's now sitting at 98 cents per share every single quarter. So again, really big dividend payments for a very long time. Now, if we look at the dividend growth rates, you can see the 3-year sitting at around 4%, the 5-year close to 6%, and the 10-year sitting at 7.76%. So typically when I invest into dividend growth stocks, I do want the dividend growth rates to be a little bit higher than that. But considering the fact this company already has a massive starting dividend yield, those dividend growth rates are actually pretty solid. Now, the big concern a lot of people have is how safe are these dividend payments moving forward? And management has stated in the past that they have a target payout ratio of around 80%. So we can see dividend payout ratio for the trailing 12 months, non-GAAP, currently sitting at around 76.77%, and the forward-looking sitting at 77. But the most important payout ratio I like to look at is the cash flow payout ratio. Dividends are paid out of free cash flow, so this is a really important metric to me, and we can see it looks like around 82.23% of their free cash flow is being used to pay out dividends. That leaves around 18% of their free cash flow left over to do things like reinvest back into the business, which I do think is necessary for almost every single business. Now, the big question is, with it trading at a 52-week low, is it trading at a good value? So to answer that, we need to jump into my stock valuation spreadsheet to see if we can find the intrinsic value of MO. We'll quickly look at a few different valuation models, and like always, if you'd like to be able to download this spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. But okay, let's go ahead and come up here and plug in stock ticker MO and hit enter, and you can see all this data will automatically load in. Now, I've already touched on the dividend data quite a bit, but you can see the 20, 50, and 200-day moving averages all down quite a bit, which is no surprise since they're at a 52-week low. Analysts actually have a target price of around $49.34, institutional ownership around 60%, and a beta of just 0.59, so you should see very little volatility with this stock. Now, the first valuation we'll look at is Graham's valuation. I'll go ahead and zoom in, and you can see the formula he lays out for us to calculate intrinsic value right here. So once I plug in all these variables, we actually come to an intrinsic value of $49.61, which again is actually right at what we saw analysts had their target price. Now, the next valuation will be the discounted cash flow analysis, and this is basically a way to see how much a company is valued based on how much free cash flow they're going to produce in the future. So you can see I'm projecting a free cash flow growth rate for the future free cash flows right here. I found the present value of those future free cash flows and added them together, add the company's cash and cash equivalents, subtracted out the total debt to get their equity value, divided by shares outstanding, and I came to a discounted cash flow price per share of $59.71, quite a bit higher than that current trading price. Now, the next valuation is the multiples valuation model. And this is a way to see how the market is valuing companies that are similar in structure. So you can see our comparable companies, take their stock price, divide by the earnings per share to get the price to earnings multiple. We take the average PE, multiply by MO's earnings per share, and we come to an intrinsic value of $38.02. So this is the first valuation where we've seen we get a little bit below the current trading price. Now, the last valuation is one I think is extremely important for dividend stocks, and that is the dividend discount model. It values a company based on how much they pay out in dividends and how much that dividend is increasing every single year. So I plugged in those quarterly dividend payments, including the most recent dividend hike, so we can see how much they pay out each year. We then can see our year-over-year dividend growth rates of around 2.4, 4.6, 4.4, and 4.2. That's an average growth rate of close to 4%. Moving forward, I'm projecting a dividend growth rate a little bit below that at 2.5%, and again, that's because the cash flow payout ratio is sitting around 80%. So while I do think they will be able to grow that dividend over time, I don't think it will be a very high growth rate. But with a discount rate of 9%, we still come to a dividend discount model price per share of $61.82, quite a bit higher than that current trading price. So when we look at the output tab, we can see all four of our valuations, average them together, we come to an intrinsic value of $52.29. So with a 10% margin of safety, you could see your acceptable buy price sitting at around $47.06. A 20% margin of safety, your acceptable buy price is sitting right at the current trading price. So in my opinion, it does look like this company is currently slightly undervalued. The second dividend stock at a 52-week low is probably one of the most talked about dividend stocks right now, and that is Realty Income Corporation, stock ticker O, currently trading below $50 a share at $49.92. They have taken quite the deep dive year to date, down almost 22%. Now, the good news about this is this pushes their starting dividend yield at a point where it's now over 6%, sitting at 6.20%. And also keep in mind, this company pays out dividends every single month. So if we look at that dividend history, you can see a very nice track record of paying monthly and growing dividends. They increase the dividend payments every single quarter, and they've been doing so for around 25 consecutive years. If we look at the dividend growth rates, keep in mind, REITs don't typically hike their dividends as much as typical businesses, but still pretty solid dividend growth rates at around 4% for the 3, 5, and 10 year. And of course, we have to look at that dividend safety, but keep in mind, this is a real estate investment trust. So looking at the typical payout ratio is not a good way to judge the safety of these dividend payouts. What we need to be looking at is if we scroll down, we can see right here the AFFO payout ratio for the trailing 12 months and the forward-looking AFFO payout ratio. Both of them sitting at around 76.5%, which is a pretty healthy range for a real estate investment trust. Now, if we come back over here to summary, again, we already discussed down almost 22% year to date. So are they trading at a good value? Well, we need to jump into my real estate investment trust valuation spreadsheet. This one's actually a little bit different than the one we just looked at. It's got some different valuations, but the first one we'll look at is the AFFO multiples valuation. You can see the comparable companies we're looking at right here, and we're looking at their price to AFFO multiple. The average price to AFFO is sitting at 16.47 for these comparable companies, while Realty Income's price to AFFO sitting at 14.83. So when we plug it into our valuation model, we come to an intrinsic value of $55.44. Move forward and look at that historical price to FFO model. Now, this is a little bit different because basically what it does is we can see how the company has traded at historically and compare it to where it is now. So we can see the current price to FFO for the trailing 12 months is sitting at 12.26, while the average price to FFO for the last 10 years sitting at 18.7. So according to where it's been historically, it looks like it actually is quite a bit undervalued. Now, the next one we've already discussed, that's the dividend discount model. I'll go ahead and zoom in a little bit, but we can see my assumptions, a growth rate percentage of 3.5, discount rate of 8%, and we come to a dividend discount model price per share of $70.66. So when we jump over to the output tab, we can see the two valuations that we used. Keep in mind the historical price to FFO is not represented on the output tab, but we did see that it was undervalued according to history. But with all that being said, we come to an intrinsic value of $63.05. So with a 10% margin of safety, it is within our acceptable buy range, and with a 20% margin of safety, it is right there again at our acceptable buy range. So it does look like this company is currently a little bit undervalued. Keep in mind, I think a big reason that this company has tanked so much is because the interest rates are so high. Investors can put their money in safe places and get a nice return, which really does seem to be hurting a lot of real estate investment trusts. The third dividend stock trading right at a 52-week low is Bank of America, stock ticker BAC, currently trading at $25.73 a share. And over the past year, it's now down over 19%, and year to date, down over 23%. Now, this gives them a much higher than normal starting dividend yield for the company, sitting at 3.70%. And if we look at their dividend history, go ahead and look at the last 10 years, and they have seen phenomenal dividend growth. If we zoom out a little bit, you can see during the financial crisis around 2008, 2009, they did cut their dividend by quite a bit. So that is something to keep in mind. But since then, they have done a good job of steadily increasing it back up. Now, if we come over here and look at the dividend growth rates, you can see they have been pretty high, with the 3-year sitting at around 7%, the 5-year sitting around 12%, and the 10-year sitting around 36.53%. Now, obviously, I don't expect it to be anywhere near as high as 36% moving forward. It's much more likely we'll see it closer to around 7% moving forward for the next few years. Now, let's go ahead and jump into my bank/financial valuation model, which is used specifically to value bank-style stocks. And now we have a few different valuations that we'll be looking at. Let's go ahead and jump into our first one, and that is going to go ahead and be Graham's valuation. I'll zoom in here, and you can see once we plugged in all of our variables, we come to an intrinsic value of $33 a share. Now, the next one we're going to look at is the historical price to tangible book value, and this is similar to what we saw with the REIT valuation spreadsheet, but it is a little bit different. But basically what we're doing is we're looking at the historical price to tangible book value over the past decade. And on average, it was sitting at 1.47. And keep in mind, we want to see this number lower. Now, the current price to tangible book value now sitting at 1.12. So it looks like it's trading at a much better value than it has on average over the past decade. Now, when we look at the multiples valuation, I'll zoom in here just a little bit. We can see our comparable companies. We're using the price to earnings multiple, and we come to an intrinsic value of $32.61. Now, the last valuation model we'll look at is the dividend discount model. We've discussed this quite a bit already, but you can see we have some really solid dividend growth rates over the last few years. Moving forward, I'm projecting a dividend growth rate of 6%, discount rate of 9%, and we come to a dividend discount model price per share of $31.09. Now, we haven't discussed the dividend safety yet, so let's jump back over to Seeking Alpha, which, by the way, you can get a huge coupon to at my link in the description. But if we click on dividend safety, scroll down here, we can see those payout ratios both sitting at around 25 to 27%. So that's a pretty healthy payout ratio for this bank stock. So when we jump over to our output tab, we can see the 4 different valuations that we use. We have grams at 33, multiples 32, dividend discount model at 31. Then we have that current price to tangible book value, which was sitting at 1.12, which is below the average. So the intrinsic value came out to around $32.23. So with a 10% margin of safety, our acceptable buy price sitting at around $29 per share, and with a 20% margin of safety, our acceptable buy price, again, sitting right at that current trading price. It looks like it is trading at a good value. So there you go. Those are 3 stocks that are currently trading right at a 52-week low that I believe are a little bit undervalued. So go ahead and let me know what you think of these companies in the comments down below. Again, if you'd like to be able to download these spreadsheets and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.